Hey guys, today we share with you our views on why we are not necessarily the biggest fans of dividend investing, and also how you should probably go about it, right? If you do want to become a dividend investor. So let's start with the why.
Okay, so there's 3 points you want to know before you even consider you want to do dividend investing. So the first one is your time spent on stock research. The second is personality, and the third is which wealth cycle are you in. And we'll go through one by one these 3 points, and we start with the first one. So the first one is time spent on stock research. Now, if you are enthusiast in terms of like researching stocks or analyzing companies, right? You spend hours daily researching, right? Then most likely you will be discovering a lot of like great ideas, right? That not only can give you like great dividends, but also potentially can give you like in terms of great share price appreciation. You never know, like capital gains. So number one is very important, is that if let's say you don't really have the time to research, then probably sticking with dividend investing could be one of the option, or just simply invest in your EPF or the S&P 500. So number one, you just need to know how much time you spend on research. And then the second thing is that if you spend more time, you have to be more aggressive in your approach. So I mean, this is very common sense. If you are putting a lot of time in something, you definitely want to like pour more money into that thing that you are doing. So I don't know whether this makes sense to you or not. But what we are trying to basically say is that you need to concentrate more in terms of your investment rather than diversification. So
this is some context, is that this is how we view dividend investing and why it doesn't really suit us that much. Mainly because dividend investing gives people the impression that really, if you boil down to it, it's actually not about dividend investing for dividend investors. It's about passive income. Many investors want passive income, and that's really what matters. So necessarily, if you want to be more passive in your approach, you have to be more diversified, right? Because if you bought only, let's say, 2 stocks, 3 stocks in your portfolio, you'll be very, very volatile, versus if you had 8, 9, 10 or 12.
Yes.
So it makes sense if you are a dividend investor to spread your bets out a little bit more, and especially spread your bet out across companies that pay a lot of dividends. But where John is coming from is, and what we are coming from is, look, we spend the time to research, and it doesn't make sense to swing so lightly, right? You need to swing harder.
Yes.
But okay, so then the next one is your personality. So earlier we talked about, how much time you spend. The more time you spend, the less dividend investing you should do, vice versa. So we look at our personality, right? Now, if you link back to what I said earlier on, it ties into not just time, but also actually doing the work, right? Do you like to look at the numbers? Do you like to read annual reports, analyst reports? And do you like to really sit down and assess your investments in such a way where, okay, you analyze management, you think hard about the future of the company in the next 1, 3, 5, 10 years. You're always seeing, am I missing something out? You're going, like we have a research team, you're going to our research team and saying, hey, does this make sense or not?
Yeah.
If that's something that you like to do, then dividend investing doesn't make sense to you.
Yeah, and also you need to be open to accept criticism. I mean, most of the time when you do research, let's say you are researching in a company that you think you are bullish in.
Yes.
You have to be open to also receive if those who think that it's not only just like a one-sided analysis. You have to receive like both sides. So if you are okay and you love this kind of criticism, this kind of like research, right, then you should probably do invest more heavily in stocks.
So really it depends on you, the person, right?
Yeah.
And the second thing is actually risk tolerance, right? So this is essentially whether you are comfortable with volatility, if you are comfortable with the ups and downs of the stock market. And generally speaking, like most people, they are not comfortable with the choppiness of a single stock or a few stocks. Then you probably should go for dividend investing.
Yeah, and also spread out your bet even wider. So that it's way to hedge against this volatility and risk.
That's right.
Yeah.
So the last one is wealth cycle. So
Yeah. Okay, so this one is more subjective. Why subjective is because let's say you're in the initial stage of like working, right? You are 20 to 30, and you are at that stage of making more active income.
yeah,
You're in your job, just grinding and everything. And sometimes when you focus too much on your active income, right, you don't really have time to do research or even invest. So
right.
that was the phase that actually maybe you want to focus more on your time just growing your wealth. So by growing your wealth means you just focus on your job or focus on your business. And where investing should take place for you, if let's say you are like you look for your job, is when you actually accumulated a huge pile of gold, like let's say 100,000 to even a million, then maybe that's where you can start to think like, that's where I want to start investing. So you will eventually hit to a point where you think that you cannot grow your wealth already. Maybe that is time where you want to start to invest. But this one, it differs to a different type of personality. Who knows, maybe if you are earning a lot, you also want to invest aggressively since young, right? But yeah, it depends on your time spent on it. What's your take on this?
Yeah, that's very true. So the math I always bring out is, I mean, personal preferences aside, right? Okay, let's say what's a amount that you would like to get from dividends that serves as something that can pay for all your lifestyle expenses.
This is my own personal family.
Yeah,
right?
yeah.
Okay, so let's say around like 6,000.
6,000. Okay. Yeah. So 6,000 you will feel comfortable.
Yeah.
You will feel like you don't have to work anymore, inflation adjusted. Okay. So for simplicity's sake, let's assume that inflation doesn't happen.
Okay.
Okay, just make it simple. So 6,000 is 72,000 ringgit every year. Correct? So the way you get that through dividend investing, and you have to assume that the dividend yield that you get from investments is maybe 4%, 4 to 5%. Let's say it's 4, simple math. The amount of money that you need to generate 4 to 5% is 72,000 multiplied by at least 20. So what is that number? 1.5 million, right?
Around there, yeah.
Now, therefore, the big question, right, is not what dividend stocks that you want to buy or what's a good dividend yield, and the typical questions that dividend investors ask. The big question is, how do you get 1.5 million? And if you're starting out as a young adult, I would say even below 40, right, and you want to do dividend investing, well, if you start off with 1.5 million, then it's great. But I would imagine that the majority of people do not have 1.5 million. In fact, 59% of people in Malaysia do not have more than 100,000 to their name.
Yeah.
If you put it at 1 million, I think is single digit, right? So what more 1.5? And that's what I share with most people is, do you have 1.5 million? If you don't, then you probably shouldn't do dividend investing if you want that passive income of 6,000 ringgit every month.
Yes, exactly. So just follow the wealth cycle. The first one is you accumulate your wealth, then you want to like preserve it. That's the later on, once you hit your 1.5 million or 2 million kind of like pot goal.
Hello investors, are you tired of going through endless complex financial reports? Maybe you're sick of all the information overload? Want a faster, easier way to research stock investments? Well, we've got the solution for you. Introducing FIRL Pro. FIRL Pro is your go-to source for concise, easy to understand stock reports. We shortcut your research journey by 90%. Each report is crafted to be straightforward yet informative, taking no more than 15 minutes to read. That's right, just 15 minutes to unlock key insights about stock investments. The program works especially well if you are busy with work, family, and activities. The best part, it's totally risk-free because we offer a hassle-free money-back guarantee. If you're not satisfied after purchasing it, just email us here within 10 days of purchase for a full refund. No questions asked. Not sure about the program yet? No problem. You can check out our free sample reports available in the video description or comments below. It's a great way to experience the FIRL Pro advantage firsthand. Get informed with FIRL Pro.
Okay, but that's why we don't do dividend investing, and this is the FIRL style on how we actually invest. So a lot of people say you have to do like different type of investing style. There's like your growth, dividend, I don't know whatsoever style, but we just do purely just value investing only. So what value investing is very simple. You just find great company with great catalysts and have a great management, and you just buy it if, let's say, you think that the future intrinsic value it is higher than the current price. So it is to explain it is very that simple, but to find it, to discover it is very tough. It could be very tough. Yeah.
So one thing people do not realize about, so there's typically three, right? Growth, value, and dividend. What people don't understand is that value and growth, dividend and growth is part of value, but they are not rivals. Growth and dividend might be rivals, but they are not rivals to value, because value is what's valuable, right? And the value of a company is a mixture of both the cash it generates, the growth of the cash, and also whether that cash can get distributed, which is called dividends, right? So that's what we really focus on. We want to know what is the value, what am I going to pay for the company today, which is very easy to find out, and whether or not it's going to be more valuable in the future. And if the answer is yes, then it is an investment worth considering, and the consideration becomes bigger if the future value becomes even bigger.
Yeah, exactly.
So that's the FIRL style.
Yeah, but let's say if you watch until now and you still want to know how to do dividend investing, even though this video is not about dividend investing. So there's three rules that we usually follow. So number one is the dividend yield must be higher than EPF, obviously, because you want to find a better alternative, or basically your risk-free rate. You want to have like a benchmark.
The only caveat here is that it's okay to be lower than the EPF if the company is growing. So what people do not tend to take note of is not so much the dividend yield today, it's the dividend yield compared to your purchase price. So a lot of people they say they put 100,000, right? And they see a 6% dividend yield, they like it. The stock price might drop, and then it goes up to maybe 7%, 6.6%, but they're happy because to them they think that's FD, right? Or fixed deposit. That is like very high interest. But I think the magic for good dividend investing is if you can buy at 3% dividend yield, but then the value of the 100,000 that you put, it grows every year. It grows by 10, 15, 20% every year. And the dividend yield can still stay at 3%. But over 5 years, after your share price has grown so much and the dividend yield is at 3%, you know what it probably means? It probably means that when you compare the dividend that you get in year 5 versus the amount of money which you spend, which is 100,000, that number would probably be closer to 10% or 15%. But people don't do that because they don't calculate. So that's something to take note of. Stocks are not like EPF or bonds where the principal capital is fixed.
Yeah, exactly. So that's the number one, the first key rule. And then the second two is very obvious. One is you have to pay consistently. Even though during COVID times or even like whatever crisis, right, they can still pay without worry. And the third one is payout ratio. So payout ratio is kind of underrated because some companies, they do tend to pay like 100% or even 120% out from their cash flow or even profit. So whether that is sustainable, you have to see what is their year-on-year free cash flow that they manage to generate, or how much cash do they even have inside their war chest. And so to give an example is FPI, and you can study a little bit about FPI, then you know what I'm trying to say in this case.
So for these two, the two important components is management and industry. You cannot say also that if the company does not consistently pay out and that the payout ratio is in your estimation low, does not mean that it's not a good dividend company. And the reason is because different industries have different cycles. Right, if a company that is, let's say like Nestle, where every day or every year there will be people buying and drinking Milo and eating Maggi Mee, then you can expect more consistent payouts and higher payout ratio. But let's say if one very good dividend company historically has been Kim Long Berhad. So Kim Long Berhad is a palm oil company, and they cannot have the same kind of payout ratio versus Nestle simply because they are in an industry where, soon they need to replant certain crops, and all this need money, right? So how can they be spending all the money and paying out to you as a dividend investor? In fact, it is your interest as a dividend investor for them to not pay out money, because in a downturn when prices, palm oil prices are low, they'll need to steady the ship. And then when it's time to replant, they need to spend and use capital. How can they do it if the bank account is empty?
Yes.
So then that's the industry. Then the second thing is the management. So some companies can pay a lot of dividends consistently every year, but management decides to be greedy or for whatever reason. They take that money and they simply spend on new diversification adventures. And that's bad. So really, these are the two components that you want to look at if you want to assess your payout.
Well summarized. Okay, so potentially this is going to be our next video idea, which is our top dividend stocks. So if you guys want to check out, or you want us to make this video, if we manage to get 200 likes for today's video, we will definitely do it. So make sure to share it and spam the like button.
Share the video and like it.
Yeah.
Okay, so before we go, I just want to talk about FIRL Pro a little bit. This is where we actually share all our research, right? All our research and our portfolio to let you understand how we invest, and also to use it as a reference for your own portfolio, right? To see as a guide, not to copy, not to get stock tips, but to know, hey, what opportunities might be up there. And we write these reports, take you no more than 15 minutes to read. Very, very fast, very simple, no fancy words. And we have a great support group. Tons of other stuff I won't share here. But if you want to hop onto the program, just click the link below. And it's a paid program, by the way. And if you still don't feel comfortable, that's fine. Go check out our free sample so that you get a sense of what we are all about. But even after looking at the free sample and you're not convinced, or you just need more information, just send us an email, or maybe just leave a comment in the video, and then we'll attend to you. So with that, guys, thank you so much for staying all the way until the end. Remember, 200 likes, and then we'll get you the next dividend video. Peace.